JP Morgan Chase is launching a new chatbot. At least the press is claiming to be able to replace research analysts. A lot of you asking me what is a potential impact on the future of Wall Street equity research. Let me dive into this topic in this video. I like to start things from first principles. So let's first understand why Wall Street equity research exists. I like to think about sell-side equity research as an aggregator that connects a fragmented base of investors and companies. We all tend to focus on the Citadel, Millennium, but there are actually thousands of equity investment funds. The smaller funds in particular, they actually depend on the sell side to access the management teams of the publicly traded companies or the companies that are about to go public. And without Wall Street, these smaller funds will have no management access because public companies tend to allocate their internal investor relation to serve the biggest shareholders. And this is why sell-side analysts organize conferences, offering these clients the opportunity to participate in one-on-one sessions with the company C-suite for a fee, of course. On the other side, it's exact same dynamic. We often tend to focus on the S&P 500, but there are many smaller firms with lower market caps. They also desire investor attention. Sell-side research provides that necessary reach for these companies to connect with potential investors. Even the S&P 500 companies, they wouldn't mind using the sell side's reach to widen its exposure to a fragmented base of investors that have never known their company's story. So in essence, Wall Street adds big value through relationship building and connecting rather than through research. Think about pre-Reg FD days, the sell side can add even more value by disseminating information selectively to their bigger clients, which is the information that the smaller clients cannot get if they don't do business with the sell side. A lot of you might have the preconception that sell-side research is about analyzing companies, performing financial modeling, and publishing reports. Yes, the job still involves these tasks, but these tasks are not the primary metrics sell-side analysts are measured on in terms of performance and, more importantly, compensation. So much of the job is building relationships with people who can help you, the senior research analysts, add value to clients. And that means connecting on a personal level with investors, company management, and professionals in your covered sector. Providing intelligence on stock movement. Analysts are talking to a variety of investors on a daily basis, so they can help clients understand what is moving stock prices and the role of connecting investors with the issuers, who are the companies. Now, I hope you realize by now, given how much of the job is relationship driven, I don't think AI will be able to replace so much of the value add of sell-side research. Why is there so much reliance on sell-side analysts? Here are the reasons. Well, first of all, corporate access. Many investors value the importance of ascertaining the people who run the companies they're researching, as they should, but not all firms do. That is absolutely something the sell-side analysts can provide because they're interfacing with the senior management on a daily basis. And human relationships, especially when you are dealing with top-level individuals, these relationships must be built with a personal touch. I'm skeptical that AI can replace humans in the task of connecting with other human beings. Second, primary research. This is particularly relevant in an era where information is freely available on the internet. Primary research has become more important than ever, especially in complex sectors. The senior analysts, they are attending conferences and are engaging with customers, suppliers, and resellers. For what purpose? They want to understand industry trends and, more importantly, getting a sense of possible inflection point before they show up in a financial statement. Because by the time the numbers start inflecting in the financial statements, the stocks have already moved, and that's not what an investor want to hear. Investors, they cannot attend every single relevant conference themselves, so they have to rely on the sell side for that. And to my understanding, AI models are built on existing information, which means they lack the insights that the analysts are gathering from first-hand interactions. Something that's a little bit out of scope for this conversation is analysts are also very motivated to protect their moat by ensuring that the AI does not free ride on their unique, valuable information and human connection. So they might be reluctant to divulge that information by publishing it publicly, which means you will continue to call the analyst instead of using some AI chatbot that the firm and the press are claiming will replace them. You're probably not happy about that if you're the analyst, right? Investors care about positioning and market flow. For many market participants, they care about what other participants will do or are doing. And sell-side analysts are talking to a variety of investors on a daily basis. Building and maintaining these buy-side relationships, that requires interpersonal skill. That to me is really difficult for AI to emulate. And also there's a capital market aspect. A respected analyst's coverage can really help a company's stock performance by increasing its visibility among investors. Regardless of whether the company is already public or going through the IPO process, human connections plays a role in making an investment decision, whether for the right or for the wrong reasons. This is the exact same reason why management must do roadshows before a company goes public. These are personal connections that are very important for gaining trust and the investment. Again, I'm skeptical that AI can play a lead role in such personal and high-stakes settings. Imagine down the road, large language model becomes a lead-left banker for an IPO. I'd love to see that happening. Finally, it's just the pattern recognition. I might be wrong, but AI models are predicting based on historical data. Investing does involve pattern recognition, but every actionable investment idea in the future might just involve some nuances that we have never seen before. They say history doesn't repeat, it does rhyme. The problem is precisely that the history doesn't exactly repeat. Let's assume AI can get intelligent enough. If enough of the market becomes AI-based investor, they might create market inefficiencies that could in turn present opportunities for human investors to make money again. Market inefficiency will always be somewhere. So I think because so much of the sell side is human relationship driven, I think AI for now will be a time saver, but it cannot fully replace the relationship building, primary research, industry insights that sell side analysts can provide. And I believe the most invaluable intellectual capital will continue to reside with the senior analysts who have accumulated decades of knowledge, relationships, pattern recognition, and most importantly, judgment. The rise of AI and these GPT-based products have been a blessing. And I think it has potential to significantly benefit Wall Street research by handling the routine, low-value tasks. I've been a junior on the sell side. I understand how much time is wasted on a job that could be reallocated to higher value activities. So I'm thrilled about having an AI chatbot for work. I don't know about you, but I worked at a bank. We had these financial advisors who can be a piece of work. Let's say there's a financial advisor, Harold, from Topeka, Kansas. Sorry, I always pick on Kansas. Now he calls me. He said, hey, I want access to your analyst and I want to ask this question that I could easily find in the 10Q about this earning releases EPS for this company. Now I'll just point Harold to the chatbot so I can focus on higher value activities such as building relationships, understanding market trends, and producing insightful reports. That's good for the entire profession. For senior analysts, I think you're totally fine. Just continue to leverage and deepen your relationship with the entire ecosystem, whether that's clients, company management, industry professionals, subject matter experts. Your network and the trust you've built are still your greatest asset. For current associates, you should learn to leverage AI tools to handle the routine and low-value tasks. So you can focus on gaining a better understanding of your industry, the companies you cover, so that you can provide a more insightful and strategic analysis, which is increasingly important as AI takes over the most basic tasks. For those of you who aspire to break into the industry, the competition remains fierce. That hasn't changed. I argue it becomes a little bit harder because now you can no longer rely on just possessing the foundational technical skill as your main differentiator. Since AI can do them more quickly, more accurately, now you must stand out through your process, judgment, and interpersonal skills. Ultimately, the senior people are looking to hire someone with the potential to be lead analysts who can build and maintain these high-power relationships within the capital market ecosystem. I don't think AI is going to make the industry obsolete. I think generally it is a positive development for the industry. It allows for the automation of lower value tasks, freeing up the human beings to focus on higher value activities that benefit the clients, company management, the firm, and the entire capital market ecosystem. And I don't see how AI will become a formidable threat to the core relationship value adds of the profession. If you have opinions on this matter, please comment or find me on the internet and DM me. I love to hear, as long as you're not a dick.
Well, thanks for watching. I'll see you in the next 2 videos on the next screen. Talk to you next time. Peace.